We'll go ahead and call to order the Finance Committee meeting. Today is Thursday, April 1st. It is 5:30. First thing, I'll take roll call. Mr. Salgado present, Mr. Schultz,
Here.
Mr. Butita,
Here.
Mr. Arena,
Here.
Mr. Hoffman,
Present.
Ms. Crosby,
Here.
and Mr. McDonald.
Here.
Let the record reflect, we do have a quorum this evening. Next item on our agenda is the approval of October 29th and December 17, 2020 minutes. Can I get a motion and a second? Motion by Mr. Hoffman, second by Ms. Crosby. Thank you very much. Discussion on the minutes. Seeing none, I will take a roll call. Myself, I'm a yes. Mr. Schultz?
Yes.
Mr. Butita?
Yes.
Mr. Arena?
Yes.
Mr. Hoffman?
Yes.
Ms. Crosby?
Yes.
And Mr. McDonald?
Yes.
All right, the motion carries. Thank you for the approval of the minutes. Mr. Thompson, do we have anyone registered to speak today publicly?
No, Mr. Chairman, we don't have anyone signed up to speak. We have several guests with us this evening, but they will all be speaking for specific agenda items.
All right, thank you very much, Mr. Thompson. So we will go ahead and omit the public comment section and move on to our next item, which is letter E, which is the presentation of the audit of the 2020 audit to Mr. John Rader and Baker Tilly. So I'll hand it over to them. Thank you.
Thank you, and good evening, everybody. I appreciate you having us at your meeting tonight. As mentioned, my name is John Rader. I'm familiar to some of you, I'm sure, and I've been part of the county's audit for the last several years in the role of a director. And along with me is Cassandra Chase, and Cassandra is also, she plays an integral part of the audit, so I'm glad that she can join me on this call as well. Cassandra is a manager in our firm, and we are going to share some presentations with you as far as the audit results go. Before I jump into, we have one document we're going to walk through, and I'll share my screen if that's okay to go through that. But before I do that, I just want to mention a couple of brief things about where we're at. We issued finals just last week on March 26th. So despite these challenging times we've all been living in for the last just over a year now, we were able to complete the audit being remote, which would have been pretty tough, 10, 15 years ago. But with the use of technology and sharing screens and electronic documents and everything, we were able to accomplish that and also issue the financial statements on time so that the county can issue them or submit them, I should say, to the Government Finance Officers Association, GFOA, for what will hopefully be another year of receiving that award. We've also, I should mention that we've issued what we call a clean opinion or unmodified opinion on the financial statements. It means that they've been prepared according to generally accepted accounting principles or GAAP. So that's the highest level of assurance you can receive from an external CPA firm. We do a couple other audits for the county. The compliance piece over the federal awards, the single audit, is ongoing right now. Actually, it started today with the planning phase. And so we'll be testing those programs over the next month or so and issuing that report shortly thereafter as well. We also started doing an audit of Baxter Road, the TIF, and that's almost in the completion phase too. So the testing has been done. We're just pulling the report together. And lastly, the circuit court. The AOIC requires that audit each year, and that's been completed and issued as well without any findings of compliance or financial reporting matters either. So that's where things are at. As I mentioned, for the financial audit, there are two deliverables. There's the financial statements, your comprehensive annual financial report. It's a really large document. It's 228 pages. But if you look at them in PDF, it's 300 and some. I'm not going to walk you through that. I think I'll spare all of us. We've got some good summarized information at the end of the document I do want to walk through, and I'm going to turn over to Cassandra at that point to talk about the numbers in a more of a graph layout. So I'm going to share my screen. The one thing I want to mention is I encourage people to ask questions. This committee has asked questions in the past, which we appreciate. You can do that as we go or save them for the end, whatever you prefer. So I'll share my screen. Everybody see that?
Yes.
Mhm.
Okay. All right. So this is a document that looks new to you probably. We used to issue what we would call a variety of different names, but it was basically an internal control report. And we've revamped that throughout the firm, throughout the country, to come up with this document. It's called Reporting and Insights. So it's some high-level information about how the audit went, what is an audit, some financial results at the end. So I'm going to touch on some key pages on here, starting with pages 5 and 6. And you should have all received a PDF version of this, I believe, as well. And paper copies are being sent out. Page 5 and 6 kind of just get at what are we talking about? Because quite often there's a misunderstanding of what an audit is. And this kind of lays it out because it can represent a lot of different things. Sometimes when things go wrong, there's a call, let's do an audit. And that might be a right fit in certain situations. But what we're really doing for the county in this situation is, like I said, issuing that opinion on the fairness of the presentation of your financial statements. So that involves planning and performing the audit, make sure that they're free of material misstatements and materialities based upon each opinion level or each column within the financial statements. So the general fund is one opinion level, River Bluff is another. Taking a look at the risk of material misstatement, of course, performing procedures, confirmations, validation, analytics, a whole bunch of things that we do. And then ultimately, like I said, expressing an opinion on the financial statements to make sure they're presented according to GAAP. This other point down here is getting at the compliance piece that we just talked about. Because it is a single audit, there's a couple different levels of compliance. One are certain laws and regulations like arbitrage and such, but then there's the federal side too of your award programs. So enough said about that. Those are our responsibilities. The county has responsibilities too, and those are laid out here. You don't actually prepare your own financial statements, but you come close. You provide us with all the data that then we can pull that together. It's kind of a matter of convenience. We do that for most of our governmental clients. So preparing that in a manner that's auditable, establishing and maintaining effective internal controls. That's a very important part of our planning phase and our assessment phase, and a couple other things here. Pages 11 to 16. Couple things I want to point out. These are some of the key areas that we're spending quite a bit of time on. Obviously, cash and investments, revenues, pension and OPEB liabilities. Those are fairly complex areas. Capital. These are the major components. There are others, but these kind of make up the bulk of the balance sheet and income statements that we're auditing. Then this report gets into what we call internal control matters. So just like I said, the internal control report that we used to issue, it's still all here. It's just built into the body of this. And so a couple of things I want to point out to this committee that I want to bring to your attention. So internal control remit, we didn't have any material weaknesses. Material weaknesses are things that where there are not controls in place, or they're in place, but they're not functioning, that could then result in a material misstatement to your financial statements. So we didn't have anything that would rise to that level. We did have what's called the significant deficiency, and these are just, like I said, these are combinations of things that could result in misstatements, but they're not to the level that we would think that it will allow a material item to go through to your financial statements. These bullet points down here are over year-end accounting items. So in large part, as bills are paid and receipts come in, a lot of it's on a cash basis. And then at year end, there's a determination of accruals. And some of those accruals at some of the decentralized departments were misstated. So that's at the end of this report, but we have a few adjustments, a couple of adjustments related to revenues and deferrals. So that's what that is about. What we're really looking for there is to, and we've talked to management about this, creating more controls within some of those departments over the accounting aspect, especially of year end, such as highway and others, where they know they know more about the programs than they would know in finance. Finance should really be the ones that gather everything together and make sure things are accurately reported according to GAAP. So sometimes when that's not in place at those decentralized departments, you can have these adjustments. Not unusual. And there's responses for each one of these too. And then we get into some of these other comments and recommendations. Some of these are best practices, some are control areas. It's a variety. These first couple are, again, control focused areas. The schedule of expenditures of federal awards is prepared by Molly and Jim over in public health. They do a real nice job, but ideally you would have somebody else independently reviewing that schedule before it comes to us, just like the financial information before we actually audit it. And I think it's just a challenge to find the resources to do that and the timing and such. Purchasing, again, this is kind of a best practice. We don't test over your purchase order policy, so to specifically. We have in some years when we think it's functioning, we're going to take a look at it, but it's not always being put into practice consistently in some of the departments, and that's probably just an emphasis on training. The policy is a couple years old now, I believe. Highway inventory. This is a recommendation that there's periodic physical inventory counts done. An update on that one, they actually did do this. So that comment's been resolved, and so that won't appear in next year's report. They actually determined to not be material for financial statements for GAAP. And then again, some responses to those. Back on the highway, another item that we reported last year is there was sometimes a delay in billing other governments for their share of projects, and it did cause some misstatements in past audits. Well, this year that was more timely. We just saw that they changed their procedures there and implemented some additional controls to try to capture those. So that's been resolved, and that will not appear in next year's either. So some good progress over those two areas for highway. And then we have a fairly lengthy comment that was in there. It's been in here for the last couple of years regarding River Bluff. And I kind of laid them out here by numbers because it has kind of evolved through the years. And we do a lot of work, obviously, with that fund, and the focus is in large part on the receivables and related revenues, and they have an allowance too. And so some recommendations here. One of them is for the allowance to do some type of look back analysis or detailed analysis of what those outstanding receivables are. Right now, that allowance is just a flat percentage. And actually this morning, I believe they're working on a draft policy, and I just provided some input on that, and they've made some real nice progress on that. And that's really step one, is to come up with a policy and some procedures are how are we going to estimate what this allowance should be. So we've been going back and forth as far as trying to come up with a methodology for that. But a little bit more accurate way to determine what those amounts should be. So that's one item. Another is getting to the inventory, and the pricing that they use over there is just the most recent cost, and that's really not GAAP. It's not going to be a material difference from what GAAP should be, but ideally it would utilize a GAAP method of pricing. And then there's a few comments here, which really kind of gets to some of the cash management issues that you'll see in the graphs too. I know this committee is aware of with River Bluff, but they weren't billing on a regular basis for periods of time for a variety of reasons. So now those receivables at the end of the year, at the end of your fiscal year, were comprised of 91% of them were 90 days or longer outstanding, and that stratification has been an ongoing movement for the last several years. So in other words, the receivables are getting older, which makes them harder to collect, which makes it harder to maintain cash balances. And that also relates into some of the other issues that you'll see here too. Negative cash, the cash has been declining over the last few years. And at the end of this year, it was negative cash position of approximately $10 million. And the way it gets cash, because you can't present, GAAP doesn't allow the financial statements to present a fund with negative cash. It has to borrow from another fund. And so that's coming out of the general fund to the detriment of the fund balance level, because GAAP says if you have a long-term receivable, you have to show that as non-spendable. But Cassandra is going to get into that a little bit. But again, it's all tied into the delayed receivables. And I know that since the end of the audit, the county's made some nice progress on that. It's also, there's a match receivable associated with this too. And so that receivable balance, because of the billings weren't going out timely, this match is also growing from 2.3 to $3.4 million. Item number 4, kind of shifting gears a little bit. This is very common in nursing home when there's credit balances, because there's a variety of pay sources that can cross paths and other credits that apply. So those amounted to $1 million. And so it's almost like a payable that's really in your receivables. And so while that's not uncommon, that amount is quite high compared to the receivable balance as a whole. And it requires a considerable amount of effort to go into each one of those resident accounts and clean those up. Some are valid, I'm sure, but I'm sure a lot of that can be cleaned up. The last thing on here, there's the system that they use over at River Bluff, Point Click Care, which we see quite a bit of, wasn't being reconciled on a regular basis back to your financial accounting system units. And that's something that really should occur on an ongoing basis, monthly, to make sure that Munis is capturing everything that's going on out there. So these are some of the issues that we saw at River Bluff. I know it's a number of items, and the county is doing its best to address these and move forward with them. The sheriff, this is a comment that's been in here, I think, since we started auditing the county a few years ago. And it really started with a county auditor report that did a very nice detailed analysis of the legality of some of these accounts being held over the sheriff and gave some good recommendations. And that situation really hasn't changed over the last few years. We've been going there on site each year to kind of get an update on those. But those recommendations still do continue. And the last item in this section is just a very general comment. It's we have this in all our reports, and it's kind of a trade-off between the county has to provide service to its citizens. We understand that, but there's certain associated risks when you have decentralized cash collection points. So the goal should always be to minimize those while still providing service. And when they have to exist, and they do, to try to implement some additional controls as much as possible. So these are more best practice recommendations that we have bullet pointed in the bottom part of this page. Not saying anything's wrong, just saying these are areas to be aware of. Page 17, these are the next several pages. These are required communications, as we call it. I won't walk you through these. Just a couple items I'll point out. There were no new accounting policies, GASBs, that had to be implemented this year. And I'll touch on that again in a second. There are quite a few estimates that the county has to incorporate into their financial statements. Those are listed out here. I would say most of our governments have 2, maybe sometimes 3. The county has several, as you can see here. So we're looking at the underlying assumptions for those different estimates. All right, jumping forward to page 22. So these are all the GASBs that are around the corner for the county, and the implementation dates over here on the right. Quite a few. So the GASB gave governments throughout the country a break over this last year. That was in GASB 95. It basically delayed implementation of most of them for 1 year and 1.5 years for leases, which is the big one. So 18 months that was delayed, which effectively makes it delayed for 2 years. But next year, the county will have to implement fiduciary activities, which basically will move your agency funds to custodial funds. They'll have to present an income statement. I've been talking to Molly about this for the last 2 years. So we'll work with her to get this in place. But again, 87 is the big one. It's leases. It's going to pull a lot more activity into the balance sheet. And additional disclosures in the footnotes too. So we've been having webinars and trainings, and we have a nice tool that helps try to pull this information in and analyze the leases. And we're going to start ramping this up this summer with our clients to make sure that our governments are prepared for this. All right, and then just several pages. These are more things that might be interesting or relevant to the county. If you look at this on PDF format, these hyperlinks should work, but all kinds of things that they're not really audit related, just more informational things that you may have an interest in. There's the team. There's Cassandra and I, and Aaron's a big part of the audit as well. We've got about 5 or 6 other people that are on this too, that I guess there just wasn't room on the page, but and then the letter of representation that we get from Dave and Molly. So I am at that point, I'm going to turn it over to Cassandra to talk about the numbers, unless anybody has any questions at this point on the actual auditing specific areas.
Yeah, I don't think there is. I don't see anyone.
Okay. All right, Cassandra, you wanna?
All right. Yeah, I'll take it from here. Thanks, John. Hello, everyone. As John said, I'm going to run through some of the financial highlights from fiscal year 2020. First, I'll go over the general funds results, which start right here on page 46. For the general fund, you'll see that actual revenues came in about $55.4 million, which is a favorable variance of about $2 million over the final budget amount of $53.3 million. And then similarly, looking at expenditures, those also ended favorably at $49.2 million, which is about $180,000, as you can see under the budgeted amount of $49.4. So you spent less than what you were expecting. These results generated a $6.1 million increase in fund balance or net income for the year, which puts the general fund's ending fund balance at about $26.9 million for fiscal year 2020. Any initial questions? Otherwise, we'll move into the second page here that kind of expands a little bit further on general fund balance. Okay, hearing nothing, we'll keep going. So as you can see here in the middle of the page, we've summarized fund balance data over the last 3 fiscal years. And as I mentioned, the general fund ended fiscal year 2020 at $26.9 million. The fund balance is made up of 3 different categorizations. So first, we've got unassigned fund balance of $10.5 million, which represents the residual fund balance that it's not assigned, committed, or restricted for any specific purpose. But as you can see, this dropped about $6 million from fiscal year 2019, which is largely due to the increase in advances. John kind of briefly touched on this. Also can be seen as borrowed funds from the general fund to the nursing home and the public safety sales tax fund. I've got some notes in green there that kind of show, so the advances increased by $5 million in the public safety sales tax fund for a total advance of $5.9 million as of year end. And then the nursing home advance increased $6.7 million, ending at a total advance of $10 million from the general fund. And so since I just touched on advances, let's look at the non-spendable fund balance next. So non-spendable fund balance, that typically represents its assets to the general fund, but they're not in a spendable form, such as long-term receivables, prepaids, or in this instance, advances. You'll see that this non-spendable category has increased just under $12 million from fiscal year 2019, which again is due to those increases in advances. That non-spendable fund balance is 99% made up of advances. So that other 1% is inventories and prepaids. And then lastly, we've got the assigned fund balance category, which includes spendable fund balance amounts that are intended for a specific purpose. So they're broken out separately and set aside in the financials as assigned fund balance. You'll see the general fund has $200,000 in this category for potential future capital asset purchases, which I believe in this case is for a potential purchase of a parking lot purchase, which is the same as what it was for last year. And then lastly on this page, we'll take a look at the county's minimum fund balance policy and how the fund balance results lined up with that policy. So as you know, the county has a policy to maintain a minimum unassigned fund balance in the general fund and in the public safety sales tax fund that is equal to 25% of the fiscal year's expenditures, or about 3 months worth of expenses. That first line there summarizes the fiscal year 2020 expenditures for each fund. 49.2 million in the general fund, and then 32.1 million in the public safety sales tax fund. And then the second line kind of computes what that 25% or desired unassigned fund balance amount would be per the policy. And then right below that is the actual results of unassigned fund balance. And then as you can see, both funds are coming up short in comparison to the minimum policy amount. General fund is about 1.8 million under, and the public safety sales tax fund is at 7.6 million below that point. Any questions? And we'll move into the next page. All right, so we'll take a look at the financial results of the other governmental funds that the county has. So first, we've got the public safety sales tax fund, which had revenues, as you can see, of 27.1 million, expenses of about 26.8, and then other financing uses in this case of 5.3 million, which is made up of transfers, as you can kind of see with the yellow highlighting. It's made up of transfers to cover debt service payments, generating a net loss of about $5 million for fiscal year 2020, and then leading to an ending fund balance of about $450,000. Moving over to the IMRF fund, which you can see generated a net loss of about $550,000 for fiscal year 2020, and then an ending fund balance of about $4 million. And again, that fund also had some other financing sources and uses for debt service payments. And then next we'll look at the tort liability fund, which again, as you can see, had a generated net income of $660,000, which led to an increase in fund balance of about 1.3 million is where that fund ended for fiscal year 2020. And then lastly, we've got all the other non-major governmental funds, which generated a net income of about 10.2 million for fiscal year 2020, and then a year-end fund balance of 60.6 million. And then we've got that broken down a little bit further into the specific non-major fund categories, which are the special revenue funds, debt service funds, and your capital project funds. Just a couple quick items to mention, some main highlights. Special revenue funds had 6.2 million in net income, and the biggest component to that was your mental health tax fund, which generated about $3.6 million in net income this year. And then the other big component of that was capital projects fund, which had about 3.6 million in net income. And kind of the big component of that was due to the 2020A capital projects fund, which generated about $2.9 million in net income due to some issuance of debt. So that fund had some proceeds this year, but not all of that was spent in fiscal year 2020. Any questions at this point, or we can move into the next page? All right, hearing none. So we'll take a look at the proprietary fund results. River Bluff generated an operating loss of about 4.1 million. And then when you factor in those non-operating revenues and expenses of 1.8 million, they ended with a net loss of 2.3 million this year, which led to an ending net position balance of about $2 million. And same as in fiscal year 2019, these losses are, as John kind of mentioned before, largely due to some untimely billing over the years, cash management issues. But again, with that said, it appears, Mark stepped into this role nicely. He's working hard to get, caught back up with billing. And I think John covered this again, but just to retouch on that, we did notice some pretty large receipts coming in fiscal year 2021 that pertain to the nursing home, which could be seen as a promising sign that things are starting to turn around as he gets caught up with billing. So next, moving over to 555 North Court Street Fund, that generated a small net loss of $1,500, leading to an ending net position of 3.4 million. And then lastly, on this page, we have the internal service funds, which we use to account for interdepartmental type costs, which had a net income of 2.2 million in fiscal year 2020 and a final net position balance of about 6.5. Any questions on the proprietary funds before we go to the next page? Okay. Lastly, on this page, we've got an overview of margins and the debt service expenditures. On the top half of this page is where we detail out the legal debt margin. The statutes state that the county's total indebtedness shall not exceed 5.75% of the assessed value of taxable property within the county. So based on the equalized value, the legal debt limit for fiscal year 2020 was at 233.7 million. And the total county debt outstanding that is applicable to this limit was at about 11.1 million, which comes out to be about 4.74% of that total debt capacity. So a lot of room there, which creates a legal debt margin of 122.6 million. So as you can see, the percentage of debt capacity being used, it did decrease about 1% then from fiscal year 2019. Less debt outstanding. All right, and then next we've got a summary of debt service as a percentage of non-capital expenditures, which we're calculating out here in the second half of this page. So total principal, debt principal, and interest for fiscal year 2020 came out to about 20.7 million. And then we show the total governmental expenditures for fiscal year 2020 of about 151 million, and then less the amount of capitalized expenditures of 5 million. Gives you a total non-capital governmental expenditures balance of 146 million. So in conclusion, then the total debt service payments as a percentage of that non-capital expense amount is about 14%. So up about 3% from fiscal year 2019. So spent a little bit more on debt service payments this year than compared to last year.
Yes, this is Steve. I'd like to raise a comment on this page, if I might.
Yeah, sure.
Go ahead, Steve.
Okay, thank you, Mr. Chairman. The top section, frankly, from just a first blush review would suggest that we can borrow just this huge amount of money. But in reality, the debt service or the repayment on the debt, the cash flow that's available for repaying the debt on an annual basis is a more relevant and critical number to look at. And when we look at our cash flows in terms of where our money goes, the revenue that's available to cover expenditures, we don't have the margin to add a substantial amount of additional debt that you're showing on this page, because we're spending that money, that revenue, on other related expenses just to carry on our operations.
That is correct. I mean, there's the top half of this analysis is really a statutorily defined amount.
Right.
And I can tell you that most counties that we audit, they don't come close to using their debt limits. It's generally 10% or less.
Yep.
And so you're right within those norms that we see. The debt service is by far the more important component. And generally you look for 20% or less of your non-capital expenditures going to debt service. It might vary in certain years, especially with a municipality that has active TIFs or something like that. But in general, you want to keep it at 20% or less. And again, counties are typically a little bit less than that. So I think the amount, it's more important to pay attention to trends, because 14% is not really of concern. But if that continued to trend upwards, then that's something that you would want to address through a policy or something else. But I know you work closely with your municipal advisors too to make sure that your debt load stays consistent from year to year. What does fluctuate though is expenditures. And I know with everything with the pandemic going on, the county cut back just like everywhere we go to. So that probably drove a little bit of that increase from 11 to 14% this year, because it's the rest of your expenditures go down. Your debt is what it is. You can't cut back on your debt that's outstanding. And so that probably caused maybe a 1 or 2% increase there. But I would agree with what you were stating.
Yeah, same. Any other questions? I think this was the last page that I had that went really quick. So if we need to go back to previous pages, happy to do so.
Yeah, does anybody have any other questions regarding the financials and the financial audit piece?
I have a question, Mr. Chairman.
Go ahead, Mr. Arena.
So just on page 48, under the public safety sales tax fund, this line, other financing sources uses, what does that number represent? I missed.
Yeah, sure. So that represents transfers out of that fund into the debt service funds to cover debt service payments.
Okay. So we use $5 million of the public safety sales tax for debt service on, is that for the building, for the jail? Or would you not know that?
Yeah, off the top of my head, John, I'm not sure if you've
Yeah,
got
I'm
that.
looking at-
Dig into
Yes,
our work
it
papers
is.
quick.
This is Steve. Mr. Arena, yes, that is the debt service. And that 5.3 million is actually reduced down substantially when that indebtedness was refinanced, because it used to be that the portion of revenue that went to debt service was substantially larger historically than this 5.3 million. But when they did the refinance, and this was controversial at the time, they extended out the payments over, I think it was another 12 to 14 years. And in so doing, they reduced the annual amount that comes out of this fund toward the debt service, which was refinanced.
I see. Okay, thank you for that explanation.
Are there any other questions? All right, seeing none, and John and Cassandra, do you guys have any other information for us?
Yeah, I think, I know I can speak for Cassandra and the entire team, is that we appreciate being the county's auditors and really enjoy working with Molly and Dave and everybody else there. They're at all the different departments too. So it's a big effort. It's a big audit, and it does go well because of their preparedness, and keeping in contact with us throughout the year versus just the weeks of the audit is greatly appreciated. So, and if you do have anybody on the committee or the board has questions down the road, we're always available to try to help out.
Thank you very much, John and Cassandra, for your hard work, and thank you for the finance team for the extensive work they do on day to day. So appreciate that, much appreciated. All right, with that, no other questions or actions for that, we'll move on to our next item, which is a presentation and status report by the Winnebago County Tax Agent. And so I hand it over to Mr. Thompson, and I believe Mr. Mr. Gilberti, and obviously our agents there, Mr. Dunn. So I'll hand it over to you guys.
Yes, thank you, Mr. Chairman. Dave Rickert, do you want to introduce who's all on for the presentation? I know Mike Dunn Jr. and some of his staff people, Eric Setter and others. But Dave, do you want to make the formal introductions?
Yes, R1P is the county's tax agent. They took over from Ballinger. They've been doing this for several years. Eric Setter handles a lot of the day-to-day operations, and we've had meetings and conversations with Mr. Dunn in relationship to the tax agent services. One of the reasons why, after discussions with the chairman and with Pat, in regards to the tax agent, we felt it was important to let the finance committee have some direct contact with the tax agent to answer a lot of the good questions that we've been getting, rather than being the go-between for those services. It made a lot more sense to invite our tax agent in give a presentation and get some of those questions answered directly. So I appreciate Mr. Dunn and Eric Setter coming in today and preparing a presentation for the board. And I look forward to listening to the report.
Okay. Mr. Dunn, Mr. Setter, if you want to.
Sure. Good evening, everyone. Thank you for having me. I'm having one quick difficulty getting my PowerPoint up. If everybody could indulge me for another 10 seconds, I'd appreciate that.
Just real quickly, for those of you that aren't familiar, when we have a tax sale every year with the property tax process, we have a tax sale for parcels that go unsold. And part of the job of the tax agent are for properties that do not sell at the tax sale, they act as the county's default buyer, and they provide a very valuable service for the county. And that their job is to find willing buyers for these properties in order to get the redemptions from those properties once they go to the tax sale process. So it's a valuable service provided to the county. Traditionally, for most counties, the service is outsourced to an outside provider. Some counties do that internally, but almost all counties now outsource that service to an external provider. And depending on the level of services provided, that could mean several different things. But I won't speak in depth on for Mr. Dunn and his team. He can well explain the unique services his firm provides versus other potential agents that provide the service. So hopefully I filled in enough airtime for Mr. Dunn and R1P, and I can turn that back over to them.
Sure. So let me share my screen if that's okay. Can everyone see my screen?
Yes.
Great. So as Mr. Rickert said, we became the agent in October 2019. And since the transfer of the agency from Ballinger to us, we've had 2 online auctions, and we now have a third currently active, which started last Friday. And in May, we generated sales after some that might not have closed at a value of $345,000. And then this last December, $590,000. I think we all know at this point, after meeting a few times, what the county trustee program is, and Mr. Rickert did an adequate introduction on what it is. And I'll fly through this PowerPoint as quickly, and I'm happy to answer any other questions. Eric, is there anything that you'd like to say on an introductory level?
No, I think we'll kind of go through this and maybe bring up a couple points in between, but this should cover most of the general concepts of what we're doing.
Great. This is pretty much the delinquent tax sale system. Property taxes become delinquent. There's an existing tax sale. If there's no tax buyer, the county trustee by default assumes the tax certificate. And in about 3 years, there is the ability for us to petition the court for a deed. And when we have that deed, we attempt to sell the property at the highest dollar amount. Move this a little bit. And, what we brought to the program 2 years ago, after hearing feedback from a number of the taxing districts, and knowing that we were going to play the role as Northern Illinois Land Bank, was that we would focus on growing EAV, which I think we've done. And we have a couple examples of the magnitude in which EAV was grown. Focus on maintenance of properties. There was a lot of liens that were unnecessarily placed on these properties, which prohibited the sale because of the lack of maintenance that was being conducted on them. Also, there was a theory, which I think has penciled out, in that values were suppressed at auction because of the quality and condition of the property. Lastly, we were trying to save a lot of these structures before the only option was for them to be demoed, which is more costly for everyone. When we were appointed agent, we did a few things that I think helped kind of conform to the modern real estate market. One was we created a online sales system that we're also using at the land bank. That online sales system has reached over 2,000 unique individuals compared to auctions in the past. We decided that there was a lot for a county of our size and the type of asset class that we had in our county. We decided that there's too much redemption interest that was being moved out of the county. Pretty much should go back to the taxing districts. And we decided that the communication could be improved between municipalities, municipal attorneys, and the trustee program. And that while municipalities don't have a say in the auction, to give them that communication channel to the chairman and the county admin on issues that they see with some potential buyers was a healthy thing and a good thing. And to create a channel for them to have a say in the types of properties that were being purchased by individuals that a municipality might have had past experience with. Next, this was the distribution of proceeds prior to our agency. In a typical year, you might have redemption interest of $350,000, sales of $222,000. That redemption interest would go to the agent. We are your new agent, and we are not a private law firm. We are not a private tax buyer. We're government, and you are one of our 7 owners. And so for us, we don't need to take that redemption interest. And I think that what you'll see in our numbers definitely was a step in the right direction to create a program where that redemption interest is lumped in with sales and distributed to all the taxing districts. On the sales standpoint, in the past, they take a 25% sales fee on all and the taxing district, all the interest, all the sales, taxing district only gets 75% of sales. And so in that scenario, the agent in that year over $400,000. And if we factored in the cost that municipal taxing bodies had for maintenance countywide, in some years, the beneficiaries of this trust actually lost money and didn't see a net savings or a net win in recouping their EAV. Currently, under these theoretical numbers, are actually underperforming what actual results are. You have redemption interest in sales at $572,000 now bundled together, same numbers as before. Take out that maintenance, and maintenance in our first year, we were very frugal. Maintenance was under $100,000, but even at $200,000 with legal fees of $180, you still had a net of $128,000 back to taxing bodies, and that's after maintenance and after legal fees. And then we had in our agreement that after all expenses, 33% of proceeds would be reinvested into the land bank for additional purchasing of blighted properties to prevent those properties from going into the trustee program to begin with. That was the real innovative piece, was that we're trying to liquidate this program. We don't want it to be full of these 1,200 properties. So the trick is to get many properties out of the program and slow down the amount of properties coming into the program. And that's where the land bank can step in ahead of them and purchase more of these properties. They're in better condition because they're not sitting in the program, and quickly get them back into private sector hands and get property taxes paid on them. And all of that has been happening. And so finally, you know, where we were with the idea of switching to this new methodology program, and where we are about to show you some more financial results, is that we're going to have increased sales by our online system. Maintained properties have, in our opinion, brought us better auction results and better bids from would-be buyers. We have seen a reduction in blight, especially in some of our more dense neighborhoods. And we believe that through some of these tracking some of the progress of what end users and private owners have done with the properties and sold them since they bought them from us, that we have accelerated redevelopment opportunities in neighborhoods and increased EAV. And lastly, we think that there's way better intergovernmental cooperation amongst all of us, especially the municipalities, in how we're looking at parcels and properties and buyers. And, you know, we have examples of park districts, school districts. We just had one with District 205, where they could quickly and very efficiently ask for a parcel and have that parcel transferred into their ownership. There was a situation where 205 school had a parking lot expansion and an unimproved lot near the school that had been up for auction, and there was no bids placed on it. Was able at a minimum bid move over to that school district. And where there was many complaints in the past, a tremendous amount of complaints from municipal attorneys and others that they couldn't get that kind of communication or customer service. So what we're about to show, and I'll let Eric step in, is that we close to $1.5 million of new taxable value based on 2020 sales. And that's just on 2020 sales, let alone the auction that Eric's about to have. Eric, do you want to maybe say a few words on that, and then maybe discuss the amount of properties coming into the program?
Yeah, I think so. The county trustee program always has a cyclical nature of properties going out, which is through our sales, and properties coming in from the properties Michael and Dave talked about going through the tax sale process. So we'll always be replenishing, hopefully not at the rate that we have been, but properties are coming in. So we usually it's about 300 properties a year, and give or take a third of those have been residential houses, which are obviously the biggest creators of blight in our area and in some parts of the county. So we'll take those houses, and we're working hard to get those properties up for sale as soon as possible, get them into new hands as quickly as possible. And I think one thing we've done more so than we probably could have anticipated is being having a local office, having somebody to talk to, having a good relationship with the cities and counties. We're getting buyers that kind of are more of a bit of a local buyer because of the reach that we're getting, but they're also more understanding that, when a property sells from the county trustee program, we don't hold restrictions, we don't do deed restrictions, but there is an expectation, and the cities are notified of who the new buyers are. And typically they're following up with those new buyers and saying, hey, in some cases there's a demo order on that, and cities would have the legal authority to demolish that house the next day. But, through communication and telling people who to talk to at a city or county building department, those demolition orders are being waived and released. And we're seeing houses that were slated for demo and months away from demo being renovated and sold and rehabbed and rented out, and in some cases owner occupied. So one of those things that we couldn't really project when we were first meeting with you a year and a half ago, give or take, but really have seen some good successes. And in a couple slides, we'll have a couple of examples of those properties that a demo order and working with the municipalities has saved them money, saved the county money, and also created a good amount of EAV revenue in the future.
Yeah, and I would say more so than any financial result, that has been probably the biggest benefit of the program to date, is again that intergovernmental communication. We're finding that the beneficiaries of this trust, the taxing districts, are far happier, not to Eric's point, not just in how we're communicating to them, but their ability to communicate with the new buyers of this program. And we're finding that a lot of buyers are coming in wanting to meet with Eric and his staff in person in our offices in downtown Rockford. And they like having a physical location with local people that they can speak with, during business hours. And the fact that Eric can just run across the street to the clerk's office at any moment, I think you did today, Eric, even. That's, I think, a huge benefit to all of you and to the county government, that your agent is that accessible and pretty much down the street. So two really neat success stories. There's a lot of them. It was Eric, I'll let you kind of do the victory lap on both of these. Go right ahead.
The first one is a property. It's on Barnum in Rockford. And this is one of those that if you drove by, every window was boarded. I think the water had been off for 5 years. Wasn't much, was headed to demolition. I think the city said within 2 months. Sold it for $3,000, so certainly not, a high amount. But that property owner renovated it, put it up for sale with a realtor, and had a almost $37,000 sale that is then going to, on the assessors and resetting the EAV. Not to mention the neighbors who have sat and looked at these boarded up windows for a number of years and haven't had any way to get them taken care of because of the cyclical nature of the county trustee program and having sale and heirs and tax buyers in and out of the process. So again, nothing really, I wish I could say we're the cause of this. We're not. We're selling the property to a private owner who, understands and worked with the city to get the water, electrical, all of that turned back on. But seeing some, in the past, if this sat for another year, this property would be a vacant lot right now. And the, taxable value would be first of all, it'd be in the trustee program for probably perpetuity, but the taxable value would be $500 at the most. So just showing that by doing these properties quickly and getting them the reach of the online sales system is proving dividends on that property. Second property is a little bit nicer. It's on Ridge in Rockford. 1922 Ridge is the property. Sold for $9,000. Again, a buyer that is doing rehab. I don't think he ever had purchased property from the county trustee program before. But you can see on the first picture on the left, that was in winter, but in the summer that you couldn't even see that property because of the overgrowth of that tree in front. So getting that property, getting a $70,000 sale, private market sale to a new owner just shows and this is one of the things that when we have quick conversations with the school district, they couldn't be more excited, not about the dividends that we would send them from the trustee from that $9,000 sale. They're excited about the $70,000 private market sale that is now going to be an EAV generator for not only this property, but hopefully has a little trickle effect for properties around it. So I'll just kind of briefly touch on this. This is the data we had initially when actually the city and county first started talking about the county trustee program and what amount of sales and interest went back and reinvested in the community. So sales are in green when Ballinger was the agent, never hit 400,000. So we figure we must have been doing something right by now that the properties closed, we're just shy of $1 million. And then adding on top of that redemption interest that is now being reinvested in the program as a part of the maintenance and the legal expenses, all of the expenses, and then being reimbursed to the community or to the taxing bodies at the end of each fiscal year. So that 2020 represents a calendar year, but fiscal year it will be pretty close to that as well. And this is, again, the 2020 calendar year of based on income and expenses, how the IGA says money is dispersed, which is mainly based on location of property sales. So that drives what taxing code gets percentage of the sales. So Rockford School District, $250,000. You can read down the list all the way down to South Beloit School District and the township.
And also, this is after the program pays the county back for the $75,000 of startup money that was provided to it out of host fees. So the first disbursement before any of this takes place is the agreement had called for $150,000. We, again, just like the maintenance, we didn't exhaust that maximum amount and really only needed about half. And that $75,000 would be the first payment made back to the county before any sort of final disbursement based on tax code.
Just an example of what type of volume we're working with. So About 11, the current for sale is right about 600, 630. There's 70 properties kind of on hold, if you will, for a number of reasons. And then the sold or under contract that we are working with, close to 400. So about 600-ish properties for sale that we have for sale right now at our current sale. I think there's 38 or so residential structures, the rest being vacant lots. So the vast majority of the properties in the county trustee program are vacant lots that have been there for 10, 20 years in the program. So they will probably not sell for in our initial sale, but we'll be coming back to the county probably later this year with some options on how to get the inventory down to a more manageable number.
So
84% of the properties in the city of Rockford. So just as a guide, that shows where the property sales are. And 40% residential structures, that represents a vast majority of that million-ish dollars of sales. We do a good amount of vacant lot sales, but most of those are going for the $500, $600, $700 minimum bids. I'll turn it back to you, Michael.
Sure. And sun setting. Happy to answer any questions that committee has.
Go ahead, Ms. Crosby.
You had mentioned that you have about 2,000 people that are registered on your online auction site. Prior to the online, how many people did Ballinger work with when it came to bidding on these properties? I'd like to get a comparison to what was and what is.
I wouldn't know. Eric, do you have any sort of estimate?
I've only heard anecdotally. The auction was at one point held either in the county board office or in some county office. So I don't think it was more than, a few dozen. I don't think it was in the hundreds, but I had never been to one, so I can't say firsthand.
Thank you very much. And then the other questions I have, let me see. We have, and correct me if I'm wrong, we have about 600 right now in inventory in the trustee program.
700 for sale, or 700 in the inventory, 600 for sale, give or take.
And do you have any empirical data? What's the average in other counties our size?
I do not have, I know that it's hard to say. 2 years ago when I was working for the city of Peoria, I think the number was 500, give or take,
okay.
In a similar city. But yeah, the number is probably a little inflated here just based upon the legacy properties that have been in there forever. We've gotten rid of the properties that have any value, and I think we've done that very well. But the properties that don't have value, we're stuck. And I think now that we have maintenance as a part of the program, now us as agent are motivated to get rid of those parcels, whether it's at a reduced cost or a different creative solution that we would need to come back. That wouldn't be our decision, that would be a county decision, but we can bring options to do that. So I think there's incentive on the county and taxing body side, and also incentive on our side as the agent to go through as many of those as we can.
Yeah, Board Member Crosby, I do remember speaking to Boone County over a year ago, and I think they were right under 200. And we just recently spoke to McHenry County, and I think they were at a 300 number from what they shared with us. So as far as the state line county, McHenry County's 300,000 people. Their numbers have traditionally been far lower than the 1,200, 1,300 properties that we had when we took over the program.
Thank you very much.
Ms. Serena, you had your hand up.
Thank you, Mr. Chairman. I have several questions. So the treasurer has told me that they've not received any of the money from sales yet. You've had, on the slide, you said there was $1 million in sales. What what portion of that is owed to the taxing district? Do you know that number?
That number is based upon the IGA that, so sales and interest
No.
are combined, expenses are paid, and then all of the taxing bodies get their portion. So without having the interest amount in there, there has not been a disbursement. I know that in our meetings with county administration, that is now in the works, and that should be done very soon here.
So, so I had asked the question of how much money is owed to the taxing districts, and the treasurer couldn't answer that question. And the financial statements that they had sent to us are vague. How are we going to get a breakdown of all the money due to the taxing districts?
Yes, I'm just looking, the amount owed to the taxing bodies from fiscal year 2020 is $234,791.
Okay, and when will that be paid?
Very shortly after we get the.
So this is for last year, right?
Correct.
Yeah, so Paul, we're not releasing any funds from the program until the opening balance that was due to us a year and a half ago that Mr. Chapman had identified is remitted to the program fund, and all the redemption interest owed to us that have all been on hold due to pending litigation. So the taxing districts are thrilled with us. We haven't received one complaint. Mayor McNamara is happy. Well, no, hold on. We have been asking the county monthly to release the funds. Chairman Shirelli has done a great job in working with the state's attorney and the administration to make that possible. Mr. Rickart's been awesome and shared with me last week that he's looking to release those funds finally in April. And Mr. Thompson and Mr. Rickert and Chairman Shirelli are very aware that the minute those funds are placed into the program, the taxing districts will get every penny. And then secondly, we've tried to communicate with the treasurer. We've sent the treasurer a lot of information. I can't speak to what the treasurer knows or doesn't know.
Okay, so nobody's gotten paid yet. So that was one of my questions, just to verify. But $234,000, about $235,000 is owed to the taxing bodies, correct? Right.
And for fiscal year 2020, yes, which we ended. So yes, short answer.
All right. And my next question is on going forward. In the questions we had asked about what's the projected legal expenses per year for filings on the current inventory, you got 185,000 plus 150,000 a year in maintenance. Can the program generate enough revenue to sustain its expenses based on the current inventory of property?
We think so, and so every year that $150,000 is prepaid for the next year's maintenance. So that's come out of the distribution to the taxing bodies. So if we do have a year where we have a slower sales or interest for whatever reason, we can that $150,000, that could be a discussion that we would have with the county to say, is some of that, do we need to hold back? Do we need to reduce that to a certain number? So we will have that $150,000 of cushion, if you will, every year, as long as we keep replenishing that as the IGA requires.
Yeah, the IGA gives us a limit. It doesn't mean that the whole thing's going to be spent. This year we spent about 96,000, and that was with the property having a lot of structures. As we liquidate properties, logic would say that we have less properties to maintain and therefore even lower maintenance cost. And we have a pretty good handle with our property management contracts on how loose to be with all of that. So if there's a slow year, it's very easy to draw down depending on the money coming into the program. There's no reason to be insolvent.
There's also it's a direct correlation between legal expense account and number of properties we get. So if there's fewer properties going through the tax sale, which would mean that we're getting fewer properties to sell for potential revenue, those legal expenses will be lowered because we're not paying the legal expenses to acquire the property.
Right, but you don't have any control over how many properties go into the tax sale. That's a function of people not paying their taxes. It takes you 3 years to cycle the properties into the program to the point where you have a deed to sell them. So we're not cutting grass and doing anything on stuff you have a tax deed for, or a tax certificate for, only ones you hold deed on, right?
Correct.
Right. So the
We're-
redemption
most of
interest
the-
that comes from the tax sale properties are what can fund stuff going forward, right? You got.
Yeah,
um,
most of the expense, a lot of the expense, not most, a good chunk of the expenses for acquiring property come in essentially the summer before the winter we acquire the property. So if redemptions are coming in, or there's a slower year of number of properties in the tax sale, there will be lower expenses in, say, June, July, August of all of the expenses to acquire that petition or file the petition to acquire the property. So it's a pretty direct annual correlation between numbers of properties acquired versus dollar amount expended in legal expenses.
Okay, and then my final question. You answered it here. I don't understand where the trustee program is paying for software for, I assume in this most recent report, you have e-property innovations, $5,896. That's the software that's marketing the properties.
Yep.
Right. So we're paying for that. We're paying for signs. Why do the signs on the trustee properties say land bank when they're two separate entities? And why are we paying for a sales site? The answer to your question was that it all goes to one place. And it seems like it's commingling the identities of the two programs. Why is
No,
that?
it's a cohesive message to the public. And I think that that's what we found. And that's probably part of the reason of our success is that every property on our website lists whether it's a trustee property or a land bank property and what that means. So the marketing expenses are an expense in the IGA that is on there. So that is split with the land bank. So it's not 100% burdened by the trustee, even though the trustee is 98% probably of the sales on the sales system. But it's for messaging to not say county trustee, not say, it's all to the land bank, and then the education happens there. So there's one sales system that people can go buy properties from a number of different sources, and then they can determine what that means once they're on the website for each property.
Yeah, we're trying to keep things very simple. This is a very complicated setup, one or the other. And for public-facing communication, simplicity seems to work best. At the end of the day, this is all local government. The land bank, the trustee program, it's all city. And again, the trustee program is more than the county. The county's the trustee, but the trust is every taxing district that is owed taxes. So Eric's decision was to have the most simple way to communicate to people that these are, local government owned properties. And that's the route he went. And it's efficient government because we brought down the cost for everyone by trying to reuse these signs.
Right. My interest is that the land bank is bigger than Winnebago County. So are we funding, whatever the land bank's doing in other counties through our trustee program?
No, because the land bank paid for a portion of the signs. And the land bank might have 5 or 6 properties outside the county at any one time. The county itself has, 800, 900 properties.
Okay, thank you. I'll let somebody else ask some questions. I have a couple more later on, but let other people ask questions.
Go ahead, Mr. Butita.
Okay, thank you, Mr. Chairman. Thanks for your presentation, guys. Just so I understand correctly, you're both wearing 2 hats. One is a trustee, as a trustee agent. One is the land bank, which is as Paul just indicated, a multi unit of government organization. So the properties that come into the trustee program all come through the process of being awarded to the county through and a court system says that turns the deed over to the county, and then it ends up in your lap. Is that the same case with the with the properties in unincorporated Winnebago County or in anywhere in Winnebago County, they go into the land bank?
No, sir.
They,
And we don't other than using the same online sales platform, which is efficient government, right? It's not, we want to have two separate online sales platforms.
Right.
Other than that, and using the same staff, because Eric's a specialist at this, so let the specialist run both programs. Other than that, there's zero commingling. There's no commingling of funds. And properties that come into the land bank only come into the land bank if the land bank board chooses for them to come into the land bank. And that jurisdiction that they're coming in from, say unincorporated Winnebago County, Winnebago County has a right to say no, even if the land bank board wants it to come in, right? So there's a lot of checks and balances and a lot of control that a city or a county has on what properties come into the land bank. And those properties are properties that are going to come in a little bit earlier in the abandonment process than a trustee parcel would. And those parcels come in typically either through a deed in lieu of foreclosure, a donation, or in most cases going to the circuit court and asking for a judicial deed because we're using an abandonment statute. And so those are properties that are kind of handpicked for properties that we think have a private market interest that we can quickly get back to the private market. And the land bank board in aggregate, whether it's in McHenry, Stevenson, Boone, are making investment decisions on the whole, property by property. The trust, to Mr. Arena's point, the trustee program are properties within Winnebago County that did not get that tax buyer and have to come in. We don't have nobody has a choice. They're going to come in. Like Eric's got how many, Eric, coming in the next wave?
300.
Yeah. So we have 300 properties coming in, John, whether we want them or not. Right. And it's our job to find buyers the best we can. And the standard for finding buyers, while I think better than it has been in the past, is pretty loose, right? Where the land bank is going to assume proposals. And they're going to let would-be buyers make a proposal. And the land bank board as an investment board is going to determine who had the best proposal. You don't do that with the trustee side. So they are two separate programs. The trustee program, without question, is governed by the county and the county board. And we are simply your consultant or agent. The land bank is a separate special purpose unit of government that every member has one board seat on.
Well, I just had, I guess, just a follow-up comment then, because based on what you're presenting tonight, versus the previous agent, Baldwin, or whatever his name was, the amount of fees that are being taken out of the county are a lot less. I mean, certainly your organization is keeping some of that for legal fees and maintenance and all that, but we were previously sending that all to that attorney in Decatur, correct? Is that my understanding? Is that correct?
So whether he had one sale or 100 sales, it didn't matter how many sales that agent had. They kept 100% of interest earned on late redemptions of taxes. So completely no correlation to how you do in performing your job in selling property, right? And so what we've done is we've said, hey, Eric and I are funded by the land bank. The county is one of our 7 owners, whether they're in the land bank or not. We're all regional planning council staff. Let us use our staff that you guys own to be your agent and bring down the overhead of running the program. Now, Paul has brought up in the past, and I don't want to speak for him, but the concern that, hey, these maintenance fees are new, and will we have the money in the future to pay for them? That was kind of the trade-off, is you're getting basically free agency with Eric's and my and Ellen's involvement, but the trade-off is the municipalities wanted some of the program money to go towards maintenance where it never had before.
Okay. All right, thank you. I appreciate that insight then.
Anyone else have questions before I go to Mr. Arena? All right, Mr. Arena, go ahead. I think you
Thank you, Mr. Salgado. So I'll be quick. You have 300 new properties coming in that you'll have deed to?
In October, October, November, yes.
And Did you know how many of those properties have structures on them? Is that what you said? The majority are vacant, or that's the inventory now is
It's
majority
usually
vacant?
about a third. We haven't looked at those, and that could end up being zero if all those owners come in and redeem their taxes this summer. That'd be great. But 300 is what we're starting with, and usually it's about a third. So by the time October hits, there'll probably be 75-ish new residential structures.
Okay, the second question is, has the county's abandonment powers been used by the land bank?
Not the counties, no.
Again? Okay. Someone asked me, I guess you have a policy on within the system that says a buyer has to fix the property up in 9 months. Is that correct?
That's on the land bank side. The trustee, we don't have any requirements for what they have to do.
And that is on a property by property basis on the land bank side. That's not a universal rule. So we determine the quality of the property on the land bank side, and the land bank board puts special conditions on the transfer of ownership. And there could be a condition that it's owner occupied and it's not allowed to be rented. Those are all home rule powers that the land bank has when it disposes of an asset.
Okay, so this gentleman, he presented the question to me, like, what happens if they don't finish? He must be looking at a property that he said doesn't look like it's going to get done in 9 months, but that has nothing to do with us. That's a land bank issue. And I should tell him, just talk to Mr. Setter, right?
Yes,
Sure.
sir. Yep.
Yeah, okay. And then my last question is, you have a policy that says that no county employee can buy a property through the trustee program. Is that any county employee anywhere?
It's part of an old legacy language. There has been a county employee that, so what our version, our attorney and the state's attorney's office reading of that is that it's probably some people that are involved in the delinquent tax cycle. So we had a public defender that bought a property, and we had it run by our attorney, the state's attorney's office, and nobody saw that was a conflict. So we do still ask that question when people are closing. So if we do know that, we'll get the opinion of the state's attorney, our attorney, bring it to, in that case, it was one of the previous ones. So we brought it to Chairman Haney saying, here's who's buying the property. But that is for everybody's conflict of interest, make sure that we're all following the law.
So does the website say a county employee can't buy the property?
It doesn't say it, they cannot buy a property. It asks if you are a county employee.
Okay, well, I was asked about this. It was a relative of a county employee, and I don't know what the language says, but apparently it was confusing for this person. And, the county employs a lot of people, so I don't think we want to limit, who can buy. I mean, you could limit it to people who can influence the system, but, if people from River Bluff or a correction officer wants to buy a property, they should be able to buy a property. So
yeah, a lot of that's state law. So we're trying to make sure we are adhering to that.
Okay, it says in state law then this?
Yes, it talks about county employees.
Okay, all right. Thank you very much. That's the end of my questions.
All right. Are there any other questions? All right, just one comment to Mr. Setter, Mr. Dunn. I appreciate the time giving us this information. One of the biggest concerns with this trustee program that came out of the gate was obviously making sure that it's for futuristic moving forward, that it's sustainable. There's a sustainable process. I think having these, whether once a year, quarterly, whatever, a reporting out, I think it's really good to have that. So we ensure that, the viability for the future of the trustee program, obviously based on expenses and revenues coming in and redemptions, are being solvent. So I just want to make sure that we're on the same page here, that I know Mr. Arena has brought, some of the questions on that nature. So just wanted to advocate for, having that line of communication. I know that, our person or liaison person is Mr. Shirelli, the chairman. So, and just making sure that we're sharing information, same with our treasurer and stuff like that. So I do appreciate your time, Mr. Mike Dunn and Mr. Eric Setter, for your time. And we look forward for the progress of this trustee program. Thank you.
Thank you for having us.
Mr. Chairman?
Yeah, go ahead, Mr. McDonald.
Just real quick, can we possibly get an email, a copy of that presentation you gave, Mr. Dunn?
Absolutely. We'd love to share it with you. Thank you for asking, Mr. McDonald. And Chairman Salgado, thank you for your comments. You know, the original intent of reporting to the board, which was an agreement that everybody around this table, I think for the most part, approved and agreed to, was that you would get a monthly report. But we followed just to Mr. Setter's point earlier on the county employee issue, we followed the legacy language that the treasurer would give a monthly report. And so we assumed you were getting a monthly, at least financial statement from the treasurer's office. They have joint ownership of the program fund with us. And so when Mr. Rickert invited us to come, we definitely agree with him and are more than willing to visit quarterly in lieu of that monthly report. So we thought that there was monthly information being provided to all of you, and knowing that there isn't, we're happy to fill the void and come at least maybe quarterly or semi-annually.
Appreciate it. Much appreciated. Thank you very much.
Thank you.
All right. If there are no other comments, we'll move on to our next item, which is letter G, which is the ETSB budget adjustment for the fire station alerting system. So can I get a motion and a second to put that budget adjustment on the table? Mr. Hoffman, and can I get a second, please? Ms. Crosby, thank you very much. Mr. Thompson and Mr. Richter, do you guys want to speak on this and give us the details behind it?
Yes, thank you, Mr. Chairman. This was a budget of $1,035,000 for a fire station alerting system. The project was half completed in 2020. It carried over into 2021. So the budget adjustment is in the amount of $490,000. So that would that's a budget adjustment for the current year budget, but it reflects a carryover of the project from the prior year.
And what's the dollar amount on that, Mr. Thompson? I think it was 490. Is that correct?
490,000 is the budget adjustment.
Okay.
And I'll let Dave speak to which fund that that is charged to.
I'm sorry, that comes from the ETSB. It's a special revenue fund. There is adequate fund balance there. Off the top of my head, I believe that's Fund 114 for the 911 ETSB board. And as Pat had indicated, this is just a rollover from last year. They weren't able to complete the program last year, so they're just rolling that expense forward. So they're asking that money to be placed back into their budget process and to cover that expense.
Okay. Are there any questions for Mr. Thompson or Mr. Richter? All right. Seeing none, we're going to go ahead and take a roll call on this, but the ETSB budget adjustment for the fire station alerting system. So I will take a roll call here. Mr. Butita?
Yes.
I'm a yes. Mr. Hoffman?
Yes.
Ms. Crosby?
Yes.
Mr. Arena?
Yes.
Mr. McDonald?
Yes.
Mr. Schultz?
Yes.
All right, I'll let the record reflect. We have unanimous consent on that. Thank you. Let's move on to our next item, which is a conversation with Sir John Gilberti. So can I get a motion to go into closed session, please? Mr. Butita, second by Mr. Hoffman. Thank you very much. So I will take roll call going into closed session. Mr. Butita?
Yes.
I'm a yes. Mr. Hoffman?
Yes.
Ms. Crosby?
Yes.
Mr. Arena?
Yes.
Mr. Schultz?
Yes.
And Mr. McDonald?
Yes.
Thank you very much. We will go into closed session for pending litigations. So Mr. Thompson, I don't know.
Yes, we transferred over.
Mr. Thompson, can you stop the stream on YouTube or make me the host again? I did it in the wrong order, sorry.
Okay, let's see here. Okay, I'm making you host.